The ascending triangle, it's taught in virtually every trading course as a high probability bullish signal. And for developing traders, it actually can become a trap. The setup looks great. It feels like a high probability trade, and then it reverses, leads to a drawdown, leads to a loss of confidence. Now, to be clear, the pattern is statistically relevant. Research indicates that it does have about an 83% success rate as an uptrend continuation pattern. Another study analyzed hundreds of price patterns over 10 years, and it found that the ascending triangle had a success rate of roughly 72.77%. So if the pattern itself is not a coin flip, why do so many traders get stopped out? I'll tell you, it's because they're missing a critical piece of confirming evidence. They react to price crossing a horizontal line, they enter the trade, but they remain oblivious to the fact that the move may have no real conviction behind it. And in this video, I'm going to show you the confirmation signal that separates high-quality breakouts from the expensive failures. Let's review the textbook definition of an ascending triangle. It consists of two main components. The first is a flat horizontal resistance line. It's like a price ceiling, a zone, where price has made at least two attempts to go higher. But sellers have consistently stepped in, so it's a clearly defined supply level. The second, it's a rising upward sloping trend line that provides support, and this line just connects a series of higher lows. This is the bullish component of the structure. It illustrates that each time sellers are pushing that price down from resistance, buyers are buying at higher levels. They're preventing it from falling as far as it did before. So the textbook psychology is pretty straightforward. Sellers are defending a fixed price level. Buyers are exhibiting increasing strength even at higher prices, and also considering that there's been no further upside movement beyond the highs. And as price compresses between the rising support and the flat resistance, you have an accumulation of energy. And the theory is that the buyer's aggression will eventually absorb the seller's supply, causing the price to break through the horizontal resistance and then trigger a strong continuation of the uptrend. Now, to trade it, the advice says wait for price to break above resistance. Initiate your long position, set a profit target by measuring the widest part of the triangle, project that distance from the breakout point. It's clean, it's logical, but real-world markets are rarely this perfect, and this simple interpretation is missing a big ingredient. And that brings us to the core issue, the very reason this reliable pattern can inflict damage on your account. It's the fake out. Now, a fake out, or a failed breakout, which is the more accurate label, this occurs when price pushes just far enough above the resistance level to trigger the buy orders of traders watching the pattern. And then it loses momentum and reverses back into the triangle. Now, anyone who bought that breakout, they're now in a losing position. Their stop losses, they become liquidity for larger players as the price declines, and they're buying. The larger players are buying the exits. And why does this happen? It happens because most traders are conditioned to react to price action. They see the price move beyond the resistance level, and the impulse is to immediately enter the trade without asking the most critical question: is there conviction behind this move? Now, a price crossing a line in isolation is just data. It could be driven by a few small orders, or it could be a liquidity grab engineered by institutional operators. These larger players, they know that a large number of retail buy stop orders are clustered just above that resistance line. They can easily push the price just enough to trigger those orders and then sell into that burst of buying to fill their short positions. This drives the price down, and they profit from the resulting cascade of stop loss orders. Now, entering a trade based only on a price crossing a line is like trying to judge the power of a car just by hearing how it sounds. You're missing the data on the actual output. You're trading with incomplete information. You're making yourself a target. So the mistake's not you identifying the pattern. It's you entering before you get confirmation that the breakout is real. Now, this is where the pros have an edge. It's an edge you can easily learn. And the key difference between a genuine breakout from a failed one It's not found in a complex oscillator. It's on your chart, and you probably ignore it. I'm talking about volume. Volume represents the underlying energy of the market. It quantifies participation. A price move on low volume is like an electric vehicle that you've never charged. It lacks that power for a sustained road trip. But a price move on a surge in volume indicates genuine, widespread participation. It demonstrates institutional conviction, at least in that moment. This is the key that unlocks the ascending triangle. A high-quality breakout is not just a breakout in price. You're going to see a breakout in volume. And here is a very simple mechanical filter that you can apply. First, observe the volume as the ascending triangle is forming. Typically, as price coils tighter and tighter, we see a compression of volatility, and volume will tend to decline, and that is exactly what we want. This establishes a baseline for average volume during that consolidation. Second, when the breakout candle forms, the one that closes decisively above the horizontal resistance, you got to look at its volume bar. And that volume bar should be higher than the recent average. Now, a common guideline is to look for volume that's 50 to 100% higher, but really the precise number is less important than the visual confirmation. The volume spike should be obvious. And that spike, that surge in volume, that's your primary confirmation signal. It's evidence that institutional capital is now participating in the move. It tells you the breakout is likely powered by real buying interest, not just a weak probe looking to trap you. So if you see a price breakout on average or worse below average volume, it's a red flag. And it's true. Breakouts can occasionally succeed on low volume, but the probability of a fake out is substantially higher. At the very least, make sure you see volume soon after the breakout if the volume on that breakout was low. Now let's put this into a disciplined, step-by-step trading plan. And if you stick to these rules, mechanically it's going to take away the emotion and it's going to protect you from making silly mistakes. So first, validate the pattern. Ensure you're looking at a legitimate ascending triangle. That's the clear horizontal resistance line. It's got to be tested at least twice. A rising trend line connects at least two distinct higher lows. And context is critical. The pattern has the highest probability when it forms within an existing uptrend, serving as a continuation signal. Avoid trading it in choppy and non-directional markets. Second, await the breakout that's confirmed. It's the most critical step. Don't anticipate it. Don't enter just because the price broke resistance intra-candle. Got to wait for the candle to close above that level. And as the candle's closing, your focus has to be on the volume. You're looking for that volume spike, an increase over the recent average. If you get a close above resistance but volume is weak, it's probably a no trade signal. Walk away, look for a higher quality setup. Third, select your entry strategy. Once you have the candle that closes above resistance, you got two primary entry tactics because now you're looking to take action because there was high volume. The aggressive entry. Enter a long position right on the close of the high volume breakout candle. This ensures you're participating early, but it does carry a slightly higher risk of a sharp pullback. Conservative entry, it's more prudent for most. Just wait for a retest of the breakout zone. Because after that initial surge, breakout traders sometimes take profit. The price pulls back to test the former resistance zone. It should now function as new support. Step 4, set your stop loss. Never trade without a defined stop loss. A logical placement just below the most recent swing low formed inside the triangle or slightly below the rising trend line. This position typically insulates you from market noise, but ensures that your risk is contained if that pattern fails. Finally, your take profit target. The standard method is just measure the height of the triangle at its widest point, project the distance upward from a breakout point. This gives you a data-driven objective. As the trade develops, you got to monitor its progress. If momentum starts to die off and volume starts to go lower as you're heading towards your target, you might want to consider taking partial profits or trail your stop loss. And listen, if you're finding this framework valuable for improving your trade execution, consider subscribing to this channel. Now, volume, as mentioned, your most powerful confirmation tool, but you can increase your odds by using a secondary indicator for a final confluence check. For instance, Look at a momentum indicator like the RSI. In a confirmed breakout, the RSI should ideally be above 50 and rising or pretty close to it. Indicates bullish momentum. You can also check the MACD, a bullish crossover that coincides with the breakout. That gives you another layer of validation. Now, don't forget that even a textbook setup with massive volume spikes can fail. Trading is a business of probabilities, not certainties. The goal is not to win every trade, that'd be nice, but to maintain a statistical edge over a large series of trades. The risk management, your stop loss, position sizing, that's what ultimately is going to ensure your longevity in trading. So, summarizing, the most common error you're going to make is reacting to price action by itself. You're going to see a line break, you're going to enter the market, ignoring the underlying conviction or the lack of it. From now on, you're going to look at it differently. You now understand that a breakout in price is more reliable when you see some volume. When you identify that ascending triangle, your first glance should not be at price breaking resistance, but at the volume bars below it. Make this simple shift in your focus. It's going to dramatically improve your results with this pattern. You're going to be more patient. You're going to wait for the market to confirm its intentions, and you're going to trade with objective evidence and not hope.
Everything discussed here is our opinion, and it is not to be taken as investment advice because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review NetPick's full risk disclaimer and privacy policy.